All right, real estate update here sa ating Real Estate Buzz.
This Real Estate Buzz segment is brought to you by McLeod & Associates, a full-service real estate and mortgage firm. It's not about the number of homes we sell, it's about the difference we make in people's lives.
McLeod, thank you once again for joining us here on Kababayan today.
It's great to be back.
Very pretty, very smart, and very accomplished, and also very giving because she's been generous with all her real estate tips with us here on the program with the Real Estate Buzz segment. Mia, summer season. I was asking you earlier, is there such a thing? You know how different industries have different peak seasons?
Yes.
What is the peak for real estate?
Definitely around the summertime, people like to move a little bit more. The children are out of school. It's easier for them. So we're seeing a lot more buyers come out of the woodwork trying to look into the market. But over the last few years, you would think around the holidays like Thanksgiving and Christmas, people wouldn't move as much. But we've been seeing buyers more open to making that transition even in the holiday.
The landscape, the landscape is definitely changing, Mia. But for the summer season, when you talk about loan programs, how much of it have changed, and do we see a lot of changes on that aspect as well?
Yes, with the home prices going up, with tighter inventory, we're actually seeing some of the lender guidelines loosen up a tad bit. But there still remains to be two main programs that are very popular. One is the FHA program. It's backed by the government and it only requires 3.5% down. And the other is the 5% down conventional loan program. And these tend to be more popular, especially among the first-time home buyers because of the minimal down payment requirement.
When they say FHA, I remember before, is it only available to first-time home buyers?
No, I know that's a big misconception. It's any buyer that's open to moving up. So let's say they own a condo and they bought a few years back and now maybe they are starting a family, they need a bigger house, and so they're going to buy a single family residence. So they can still take advantage of the FHA program for that type of purchase.
All right, thank you for clearing that with us. What do you advise your clients? When you say 3%, of course, you would rather spend 3.5% of the full amount first, rather than spend more on a 5%. But are there advantages, disadvantages to each?
Yes. Well, the FHA program again only requires 3.5% down, and that funds can be gifted. Also, along with conventional financing, they can be gifted, but the process is slightly different. Not only that, but FHA loan programs have a slightly lower interest rate than conventional loan programs. Also, you can qualify more for an FHA loan because the debt-to-income ratio that the lenders require is higher versus a conventional program. Not only that, I think a lot of people aren't aware, when you apply for an FHA program though, if you're married, you're required to pull your spouse's credit, even if they're not applying for the loan. So any debt that comes up on their credit report will also be kind of used against you in your qualification, versus a conventional loan program doesn't require you to have to pull your spouse's credit. So it might make more sense for you to go conventional. It really depends.
So it's case-by-case basis with the client.
Case by case.
Right.
But FHA is also a little looser with FICO score requirements. You can go as low as a 600 FICO score, whereas conventional 5%, you have to go 700 plus.
So many information. Thank you for explaining that to us. But I heard something there, debt-to-income ratio. What is that? We always hear that in negotiations involving real estate.
Yes. So debt-to-income ratio, we call it DTI for short. It's one of the tools or requirements that the lenders use when they qualify you for pre-approval. So whenever you qualify and you meet with your loan officer, they take all of your debt. And I just want to say, debt is not the balance of the loan, it's the monthly minimum payment. So let's say you owe $20,000 on a car payment, your car loan, and your payment is $500 a month. They use the $500 a month, not the $20,000 loan balance. So they take all of your debt versus your income and they put it into a software or whatever software they're using to qualify you. And then that will issue you what you call a DTI ratio.
Okay.
For example, let's say you are a homeowner or a buyer, you want to buy a house that's $350,000. You put in your debt and income ratio, and it comes into like 45% DTI.
Okay.
For an FHA loan program, you can go up to 55%. So that means you can actually qualify for more than 350. Maybe you can go up to 400. But let's say you put in 350 and your debt to income ratio is 60%.
Wow, okay.
That means you don't qualify for 350. You have to bring down that purchase price a little bit to stay within the 55% DTI ratio requirement.
And the DTI ratio, does that factor in the computation of your interest rate?
Yes. If you go over a certain amount, there is an adjustment for the higher DTI ratio. And then there's some loan programs like conventional. That's why you can only get qualified for less with a conventional than an FHA, because you have to stay under 49% DTI.
Yeah, let's talk about the interest rates. I keep hearing, it's going up. Is it going up or is it going down? What's going on?
I think we've all been very lucky with these past few years with interest rates in the threes, which is very, it's such an opportunity for all of us. But that wasn't the case many years ago. Even I remember our parents, when they first bought, interest rates were like 13, 14%. But in the recent weeks, we are seeing it slide up into the fours, which is still really, really low. But I think because everyone was used to the threes, they're like, oh my gosh, it's in the 4%, something's happening.
Right.
So it's still really a great interest rate. And you have to take into consideration interest rates change based on a variety of factors. The type of loan, your FICO score, are you buying it to live in that house or an investment property? So many different factors, which is why it's so important to meet with a loan officer or professional and kind of see what your options are.
Yes, and meet with somebody who not only knows these things, but who can explain everything in the way that you understand, correct?
Yes,
That
yes.
way you can choose the program that best fits you and your situation.
Yes.
That's the information on the screen. Call them right now, McLeod and Associates with Miss Mia, of course. They will help you. Thank
Yes.
you. More power.
Thank you.
Entertainment Report when we return. Don't go away.